people say, well, if interest rate's zero, there's no cost to the government borrowing. And again, this is not thinking in economic terms. This is thinking in accounting terms. If interest expense was the issue, then Japan and Europe shouldn't have any problem because their interest rates are negative. They could borrow at negative rates or zero rates, but that still isn't helping their problem. So it's not the interest expense that's all of a sudden going to make this problem go away. If the Federal Reserve set interest rates at -1 and the government was able to borrow with a negative interest rate, that doesn't change the pushing of resources to the government sector, the diminishing marginal returns, the overusing of debt capital. None of the econometric concepts that are actually causing the decline in growth will change as a result of that. So I think it is by design to facilitate more government spending. I think that is what they'll do, and I think the results will get worse as we push more resources in that direction.
Welcome to the Gold Republic Podcast. My name is Bart.
And I'm Alexej Jordanov. In our weekly podcast, we invite guests from all over the world to get valuable insights
into the emergence of a new monetary system through the lens of precious metals, cryptocurrencies, and other financial instruments.
So that is one point of also then like looking at the ownership. So this is like the government side. Then we have the central bank, right? And they both need to be in check of each other to keep a certain balance to get the economy running. And what you see is that throughout the years, the balance sheets of not only the Fed, but also the ECB, and I guess I'm not sure how much you're also watching closely or not, or commenting on, let's say, more the European or the Japan or the England, the English central bank. But you see the balance sheet hitting always new records in terms of ownership of the economy itself. I think by now here in Europe, the ECB is approaching 79, 80%, whereas before crisis was barely 70%. It's insane. And this is within a year and a half or maybe tops 2 years. It basically is a coupling of those entities into a single entity. Right. And if you take it further, it means that just like the Communist Party, now I don't want to go into, let's say, political ideologies and so on and so forth, but we could get like a planned economy-like thinking, like the 5-year plan kind of thinking from those institutions working together, trying to accommodate every part of it by tweaking those interest rates, by basically having those purchasing programs and so on and so forth, and ending up actually owning up to 100% of an economy. How could that even translate into other factors? Where would it transpire? Where would be what Luke Roman say, like the fire, I think he said, I might misquote him now, but the fire alarm.
Yeah, so I would try and tackle that in a couple different ways. You're getting at such a critical point here, and this is where my work gets more into economics versus accounting. And what's happening here is we have the private sector and we have the public sector, right? And we can make arguments all day long over, is this specific government project productive or unproductive? And that's fine. But when we look at the data, it's clear without a shadow of a doubt that on average, the private sector is more productive than the government sector. And when the Federal Reserve engages in these quantitative easing type programs, what's happening is they're trying to they're buying government bonds, which is increasing deposits in the banking system. Those deposits can then flow to new loans, new private sector loans, which would be healthy for the economy. And if the banks cannot find loans that they want to make, or consumers don't want to borrow, then they'll just park those deposits back into government securities. And as the private sector has become more indebted as well, there's friction between the bank's willingness to loan money and the private sector's willingness to borrow money. So new loans aren't being made. So all of these deposits that are getting pushed into the banking system are flowing back into government securities. And the economic effect of this is that it facilitates, like you said, more government spending. And it facilitates the pushing of resources towards the government sector and away from the private sector. And as they continue to do more and more and more and more of this, what we're going to see is them continuing to redirect more resources towards the government sector. So as the government size grows, the government needs more labor versus the private sector. So you're taking labor from the private sector to the government sector. You're taking capital from the private sector to the government sector. The government's using natural resources. So all of these programs are facilitating governments to do more of what hasn't been working. And as they continue to do this, like we see the Bank of Japan, they own so much of the JGB market that on some days there's no transactions at all in the public bond market. But yet their fiscal spending hasn't yielded any better results. Same thing in Europe. The ECB and the BOJ both own significantly more of their respective bond markets than the Federal Reserve owns of the US bond market. And my analysis would suggest that if the Federal Reserve follows the path of the BOJ and the ECB and continues to own a larger and larger and larger share of the government bond market, what that will do is it will facilitate more government spending because it will keep the bond market volatility low. It will keep interest rates low. It will signal to the government that we can keep borrowing more money and spending money because it's quote unquote free, but the results won't be there. And one factor that I really want to hammer home is people say, well, if interest rate's zero, there's no cost to the government borrowing. And again, this is not thinking in economic terms. This is thinking in accounting terms. If interest expense was the issue, then Japan and Europe shouldn't have any problem because their interest rates are negative. They could borrow at negative rates or zero rates, but that still isn't helping their problem. So it's not the interest expense that's all of a sudden going to make this problem go away. If the Federal Reserve set interest rates at -1 and the government was able to borrow with a negative interest rate, that doesn't change the pushing of resources to the government sector, the diminishing marginal returns, the overusing of debt capital. None of the econometric concepts that are actually causing the decline in growth will change as a result of that. So I think it is by design to facilitate more government spending. I think that is what they'll do, and I think the results will get worse as we push more resources in that direction. If I'm not rambling too much, I'd like to share one more chart about this. Okay, so this is what I call a debt thresholds by sector. So there was a Bank of International Settlements, the BIS, that had a paper called The Real Effects of Debt. And over here in the top left is government debt, federal and state and local debt. Everything's debt as a percentage of GDP. Now there's been dozens and dozens and dozens of papers on government debt to GDP. All of them, or most of them, fall into a range of 85% to 90% to 100%. Somewhere in that range, all of the relevant research establishes a threshold. The threshold meaning that once you go above the threshold, now the effect on growth starts to get negative. So a little bit of debt helps economic growth. As you get higher and higher, it helps less and less. And then as you cross the threshold, now you're into diminishing marginal returns. Now it doesn't help anymore. This is the same concept as the government size research, where when the government is controlling 5% of total income, it may help a little bit. As they grow to 15, it gets a little bit worse. As they grow to 50, it gets worse. What the Bank of International Settlements paper, The Real Effects of Debt, did is it expanded these thresholds to the different sectors of the economy, like the business sector and the household sector. And for the first time, what we're seeing is that we're either exceeding or approaching these debt thresholds in all three major sectors of the economy: the government sector, the business sector, and the household sector. And if you combine those three, you get what's called domestic non-financial debt to GDP. So what happened over the last 20 or 30 years was we crossed the threshold on the government sector, but we were really able this last economic cycle to lever up the business sector. Or if you go back to the 1990s, the government sector actually delevered quite a bit, but the household sector exploded. So what was going on was we were passing the baton around from sector to sector. You have too much debt, it's not working anymore. Let's go to the business sector. The business sector has too much debt, it's not working. Let's go to the household. Oh, that caused a housing crisis. We'll go back to the business sector. And where we're at now is that we've either hit or exceeded these thresholds in all major sectors of the economy. So going forward, the major struggle is that debt accelerations in any sector of the economy are now going to yield diminishing returns. And I think that's going to be one of the major challenges over the years ahead.
Could this huge mountain of debt fall on top of us? And what would the consequence be? Because this is where I find the whole inflation, deflation debate or conversation very interesting. And because we have this mountain of debt, and it would, of course, if it would explode, it would most likely create deflation.
Yes. So where I see it shaking out is of course, if there was mass defaults, yes, deflation. But what happens is as the economy gets more indebted, the economic growth rate slows. And that I showed that in the chart. And when economic growth slows, the economy is only able to support lower real interest rates being the critical factor. So debt levels go up, economic growth comes down, and the policy response from either the government, the Federal Reserve, or the federal government, the response is to do something to lower real interest rates. And if real interest rates continue to get pushed lower and lower and lower, you'll be able to sort of survive and hang on with a larger and larger debt burden. So as long as real interest rates can continue to go down, you can continue to sort of muddle along with a higher and higher debt load. And we've seen that in every country.
Yeah,
I'm sorry?
So that's Japanification, right?
Exactly. So where the rubber meets the road, which is where we're going to be heading over the next couple of years, is the zero bound, right? So economic growth goes down, 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 down. That means the economy could only support lower and lower real interest rates. Now we get to 0% real interest rates, or 0% federal funds rate. The inflation rate is a couple percent. So real interest rates are negative, right? Real interest rates are -1%, -2%. The whole economic machine is predicated on the fact that real interest rate can continue to go lower. So if it's at -2, and that's where we're at now, it's going to have to go to -3 and -4 and -5 over time if we're going to want to continue to muddle along with this debt load. And that becomes a problem because the Federal Reserve can no longer move the interest rate, the nominal interest rate. So years ago, it was very easy to get the real interest rate lower because you'd lower the Fed funds rate from 5 to 0 and you'd knock the real interest rate way down. Now we're at 0, which is why all of these unconventional tools are coming out, like quantitative easing, because what they're trying to do is hold the interest rate at 0, get inflation up to 3, 4, 5%, and that in turn will cause -3, 4, 5% interest rates. The problem with this, though, is that yes, they can hold interest rates at 0, and they can continue to spend. But like we talked about before, they're going to generate 5% inflation, and then 4% inflation, and then 3% inflation, and then 2%, and then they're going to be spending 10, 15, 20 trillion dollars and still not getting the inflation that they want, and the real interest rate is going to start to creep up. Now we're faced with the issue of does the Federal Reserve, we can't get the inflation we want on the federal, so the Federal Reserve basically has conceded that 10 years of quantitative easing doesn't yield the inflation. So now we're going to try fiscal spending. If fiscal spending doesn't work, now the only option that you have, if you want to have the real interest rate keep coming down, is the Federal Reserve has to break the zero bound and go negative. And that's what we saw in Japan, and that's what we saw in Europe. But what we're seeing in those two countries is that there's resistance to pushing the overnight rate lower than it already is. No one really wants to see the ECB go to -1.5% or -2%. So Japan and Europe are kind of holding their overnight interest rate, and they're trying to spend, but they're not getting the inflation that they want. And as a result, the real interest rate is not declining that fast. In fact, it's even kind of flat to up in Japan. And when you have a high debt load and real interest rates aren't coming down, then the economy suffers, like Japan, where you have no growth. You have 5-6 recessions in 10 years. So where this is leading is, yep, we're going to continue to try and push the real interest rate lower. We're going to get to a point where monetary and fiscal stimulus both cannot push the real interest rate lower anymore. And then we'll have to grapple with, are we going to go to negative interest rates, or are we going to sort of let ourselves experience some of this debt deflation and let it burn out?
All right. Well, it's really interesting because this all means something, and we would likely want to know how we can prepare for this this event, or this maybe slow decline. And I was wondering if there is something that you could tell about, what can Joe Sixpack do to conserve most of his purchasing power, or find some yield somewhere.
So I'm a big believer in the all-weather portfolio, or any balanced portfolio that has exposure to inflation, it has exposure to deflation, it has exposure to growth, it has exposure to recessions. I personally like the all-weather portfolio, which is a combination of stocks, long-duration treasury bonds, gold, and commodities. The commodities will give you inflation protection. The gold gives you protection if real interest rates continue to go lower. The long-duration treasury bonds protect you from the deflation, and the stocks kind of give you the return along the way. There's tons of other portfolios that seek to replicate a similar type dynamic. My belief is that a balanced portfolio that has exposure to all of those scenarios is the correct starting place. From that position, balanced to any outcome, you can then use long-term economic trends to tilt your portfolio slightly in the direction of the assets that you think may perform the best. You could also use shorter-term cyclical trends to tilt your portfolio in the direction of the asset that you think is going to perform well. It all depends on your time frame. But if we're going to go with a 3+ year time frame here, the two assets that I would overweight the most in that all-weather portfolio would be the long-duration treasury bonds and the gold portion. The reason for that is because I think those are the two cleanest ways to express a view on disinflation or deflation, which the treasury bonds will help. And gold is the policy of is the insurance policy against if disinflation does not prevail and they do something out of the box, like, let's say, change the Federal Reserve Act and go to something like a modern monetary theory. The gold will help there. The gold will also help if we do get to the point where we hit the zero bound, interest rates or real interest rates won't go any lower. They start to creep up. The gold price will go down, but all assets will also go down because assets don't like rising real interest rates. And at that point, the Federal Reserve, like other central banks, may make the decision to say, we're going to try this step and we're going to go to negative interest rates and try and knock that real interest rate down a couple hundred basis points again and see if that changes the equation. I don't think it'll change the equation, but that will help gold prices quite a bit. So I think that the best path forward is to find an asset allocation that works for your personal situation, that's balanced to the four main risks, which would be inflation, deflation, growth, and recession, and then use long-term economic trends or short-term economic trends, depending on your time frame, to tilt in the direction of the assets that you think have the best chance to perform well. For me, that would be number one, long-term treasury bonds, and number two, probably gold prices.
So gold, and what about silver?
Silver would serve the same purpose. The reason I like gold more than silver is because if we are having a global slowdown, silver tends to have more industrial use than gold. So if we go into a slowdown, I would expect gold prices to outperform silver prices. But that's actually the flip side of what I expected about a year ago, because we were in an inflation and industrial upturn. Coming out of COVID, the global manufacturing sector was booming, and silver outperformed gold pretty significantly. So if I have a long-term view of declining conditions, I'd want to favor gold over silver because I'd be worried about the industrial use of silver weighing the price down relative to gold, which is more of a clean, hard money, real interest rate type view.
That's a great point.
Yeah, that's a great point. And you see the role of gold still as important as it was in the last decades, since the 70s, since Nixon broke the gold window. In the next 40 years, or how do you see the role of gold evolve?
Gold's lasted several thousand years. I expect it to last going forward. I think it's the best representation of hard money that we have. I think there are intrinsic values to gold that are unique to it, which is why it's been money for such a long period of time. I think that gold will continue to serve an extremely important role in wealth preservation. It's something that I have in my portfolio. I always have an allocation to gold. I don't remember a time where I've had no allocation to gold. I don't foresee myself ever having a time where I have zero allocation to gold because I think that it enhances the portfolio in terms of diversification, volatility, and it provides insurance policies against massively declining real interest rates.
Yeah. So that's actually a good point. So you're a gold bug as well, or like how do you?
Yeah, no, I find gold has a critical role in just about any portfolio. I'm not a believer of put everything you have into gold because it's a sure bet. But I believe that as part of a balanced portfolio, especially if you have proper disinflationary or deflationary offsets, that it's absolutely critical.
Mm-hmm.
Just because you're still pretty young, and I can probably you probably have a group of friends around you that you talk about your investments, and of course most of them will say, well, cryptocurrencies is all the hype, but would you say that in your age group people are thinking about gold?
I would say that you're probably correct that the sizzle has moved to crypto versus to gold. People that I know still do invest in gold. I think that the group of friends that I hang out with probably is more receptive to gold than people that may be newer to the finance or investment community. After COVID, there was a big explosion of interest in the finance and investment community, and I think that a lot of that interest went straight to the crypto space. But I still find in the circles that I talk to a lot of wealth managers that aren't too much older that do feel that gold has a critical role in the wealth preservation process. It's more to me of a wealth preservation asset versus an asset that you buy hoping to triple, quadruple, 5x your money. There's obviously the possibility that gold prices go to 5,000, 10,000 based on some crazy move that they pull with the monetary system. But the more likely case, in my view, is that gold prices will reflect real purchasing power, and an allocation to gold will maintain wealth over a long period of time. So that's why if your investment philosophy is 5+ years, you're in the wealth preservation or wealth accumulation type bucket, and gold to me is an important part of that.
Exactly. Mm-hmm. That's what. It's funny because of course we hear a lot of these, or I follow some of these gurus that say, well, gold is going to 10,000, and I'm just like, if gold goes to 10,000, it's not gold anymore. Especially in very strange circumstances, and that is then the monetary system just collapses. But in a normal situation, gold is like an anchor for the rest of your portfolio, right? So exactly it's nice to hear that in your circles people are also thinking about gold as a stable part of their portfolio, where of course cryptocurrencies are much more high risk, but also much more high reward when whenever it works out in their advantage.
What do you have to say about the actual recent price movement of the sell-off we saw a couple of days ago?
So I think that to me, the most critical factor for gold is the direction of real interest rates. So a lot of people, in my view, say real interest rates are negative. That means gold should go up. But if real interest rates are -3 and they rise to -2, gold prices would go down, even though the real interest rate's negative. So it's the direction of real interest rates that is important. And I think that the sell-off in gold is based on a fear that we are going to get monetary tightening. We're going to get a tapering of the balance sheet. And I forgot the name of the Fed governor. I apologize. But one of the Fed governors came out and made hawkish comments about potentially moving rate hikes into 2022. So those two hawkish comments, in my opinion, spooked the gold market into foreshadowing higher real interest rates to come over the next 6 to 8 months. Given my view on the economy, both from a secular long-term perspective and a cyclical short-term perspective, all the things we talked about with the Fed, even if the Fed does successfully start to tighten, I believe that it will be reversed relatively quickly. So I actually was talking to a client this morning who was talking about gold and the sell-off and looking for an opportunity. And any sell-off that's caused by a fear of persistent monetary tightening, I think is a good opportunity to add some gold, because persistent monetary tightening and higher real interest rates will be basically impossible to sustain with this debt level. So
that's a good moment to buy a gold, pretty much bottom line.
Well, but I think that is an excellent analysis. And it's not because we sell gold, but I think it's just, I think it's just an excellent analysis that because financial markets are scared of interest rate hikes or tapering of stimulus packages or quantitative easing. But as you so eloquently displayed, the Fed has painted itself in a corner where they can try to tighten right into a weakening economy. It would immediately they would be reprimanded by the financial markets and then be forced to get back to zero interest rates and possibly even larger stimulus packages or quantitative easing, QE to infinity, right?
Exactly. And one thing I would love to bring up real quick, you mentioned Luke Groman, and we do come out differently on some things, but one view of his that I agree with is financial markets. So part of the early premise of quantitative easing was the wealth effect. If we can buy mortgage-backed securities and we can buy treasury bonds and we can push people out on the risk spectrum and stock prices and home prices go up, then people will feel wealthier, they'll consume more. That consumption will lead to production, which will lead to employment. And the hope was it would start what we call a virtuous economic cycle. It's not hard to figure out that plan didn't work out very well, because we had the largest boom in asset prices ever over the last 10 to 15 years, but growth in consumption was pretty bad, despite the fact that asset prices were going up. The interesting aspect about this is that the wealth effect doesn't work when assets are going up, as we've seen, but it does work when assets are going down, meaning that if asset prices fall 20% next month, we will see that come through consumption. So when the asset prices go up, it doesn't lead to more growth and more consumption. But when asset prices go down, it leads to lower growth and lower consumption and layoffs, and corporations look to preserve that. So The one example, empirical example of this would be December 2018. In December of 2018, the stock market collapsed and it was down 20% in a month. And consumption that month was terrible. The market rebounded quickly and then consumption normalized. But as the Fed over the last several years has targeted asset prices, I wanted to talk about this because you said they've painted themselves into a corner. And what we see is that they've targeted asset prices and they've tried to push asset prices higher. Asset prices have gone up, but it hasn't led to the consumption that they were looking for. But now, if asset prices come down, it will lead to worse economic growth and worse economic results. So to Luke Groman's point, yes, they have to continue targeting those asset prices. And every time those asset prices do start to come down, they will come in and try and do something to prevent that from declining. The only way they can sustainably prevent the decline, though, is if they perpetually get real interest rates lower and lower. And this is where Luke Groman and I may deviate. I think he believes that if the Federal Reserve continues to expand their balance sheet and the federal government continues to spend money, inflation will be everlasting and it will never go down. I'm in the camp that they can continue doing more and more and more, but diminishing marginal returns and econometric research tells us that more is less, and that they're going to end up getting what's going to look like a transitory bout of inflation or a transitory bout of growth. The growth rate and the inflation rate are going to come back down, and then they're going to be faced with a challenge of putting up some numbers of fiscal stimulus that I think will surprise people to get growth that's still pretty anemic.
Mm-hmm. And we have already touched upon that before, but we haven't really digged into the inflation numbers. You've also posted the most recent one, the inflation numbers that just came out yesterday, 4.2. Yeah.
So I look at so most people quote all these metrics in year over year terms. I like to use a slightly different growth rate calculation. It's called a smooth 6-month annualized growth rate, and it's got a couple of advantages. One of them is that it's not impacted by the base effect. We see a lot of these year-over-year numbers look a little funky now because it's comparing against the lockdown. So this growth rate sort of looks at the change over the last 6 months rather than the last year. And on that basis, headline consumer price inflation is about 6.5%. It increased from 6.4 to 6.5 from June to July. Core inflation ticked down slightly to about 5.5. What's interesting, though, is that today we had the producer price inflation numbers. And the producer price inflation numbers on that same metric, that smooth 6-month growth rate, is over 9%. So we have producer prices going up 9%. We have consumer prices going up about 6%. And that generally means margin compression. That generally means that corporations are definitely feeling the inflation pressure. They have 9% higher prices for the producers, but on average, they're only able to pass along about 6% of that. So that should lead over the next several months and quarters to margin compression. Margin compression or corporate margins, going back to one of the earliest questions, is a leading indicator of economic growth. Lower corporate margins, does it have a logical economic sequence? If you are a corporation and your margins are evaporating, what's the easiest thing you can do to bolster those margins? Most likely it's dramatically cut back on CapEx or dramatically reduce your headcount of employees. I think that the fact that we are seeing inflation, it's concentrated on the industrial side of the economy, the durable goods side more specifically. Producers are feeling that more than they're able to pass on. That should lead to margin compression, and that should facilitate the downturn in economic growth that's already beginning.
So it's not looking good, right? If those margins go down,
right.
They could also be isn't like raising prices itself also another option? Do they even have the room for passing on the prices increase onto consumers?
So when we look at the consumer basket, so the thing to focus on here is adjusted real income. And real income growth is only growing at about 1%. So all of the inflation is eating up everybody's income. And when we look at the consumer spending basket, there's elastic goods and inelastic goods, or things that you kind of can be flexible with your spending on versus things that you can't really be flexible with your spending on. And if we're not seeing real incomes rise really dramatically, but we're seeing prices rise for things that consumers don't have a lot of say over, for example, home prices, rent prices, and gasoline prices. Those are things that the consumer's going to have to buy almost irrespective of the price. And if incomes aren't rising, all that means is that the increased amount of your budget that's being consumed by rent or gas prices has to come out somewhere else, or it's got to be borrowed in the form of debt. So I think that there will be a continued resistance for corporations in mass passing along higher prices because the consumer income basket isn't going up at a fast enough rate to absorb the price increases across the entire economy. I think that there will be certainly price increases like we've seen gas, rent, home prices, things like that. But we're going to start to see disinflationary pressure in some of the goods that people will cut back on as soon as their budgets start to feel tight. And I think that we're already starting to see durable goods inflation peaked last month. It was at a crazy high, about 20%. It's come down to about 18%. So I think that we'll see a balancing of inflation pressure eating the consumer's budget, and therefore more consumer discretionary goods won't be able to pass on as much price.
Okay. So there's not much room of maneuvering. Thanks, Eric. I think we've had a good chunk of intellectual teasing.
One last question, maybe. Is there something that you would like our viewers to know about you, about the services you provide, or some nugget of wisdom that you would like to throw their way?
Sure. So the one point for people that may be new to my work, if you haven't seen some of it before, I think one of the differentiating factors is it's really rate of change or rate of growth, or the direction of growth that's the most critical point. I think a lot of people get hung up on the actual number. So if I said, Bart, growth is 4%, you wouldn't necessarily know what to do with that, because if growth went from 8% to 4%, that would be a lot different than if growth went from 0% to 4%. Both situations, we end up at 4% growth, but in one situation, growth's declining and assets are going to favor defensive. And in one scenario, the growth rate's increasing and you're going to have major outperformance of cyclicals, because it's the rate of change or the rate of improvement that's the most important factor. So I think I would challenge everyone that when they're looking at data, or they're looking at whether it's corporate profits or any metric, that you focus on the direction of growth, or the direction or the rate of change. I think that's the most important point. If people want to find more information about this stuff or what I do, I post some blogs on EPBMacroResearch.com. I also have a video on YouTube, which I would hopefully nudge people to watch, called The Importance of Growth Cycles. And I go into growth cycle upturns, growth cycle downturns, and how stocks perform during these upturns and during these downturns. And it gives a lot of context about the work that I do and sort of a primer on growth cycles. So I think EPBMacroResearch.com and YouTube, you can search EPB Macro Research. Those are two good places to find more about what I do. And the most important point is just to focus on the rate of change. The rate of change in stimulus too. So 5 trillion to 4 trillion, we can't look at 4 trillion. We have to look at the negative 1 trillion delta.
Grateful for all your knowledge and wisdom and your charts. Your charts are amazing.
No, thank
Thanks,
you so
Eric.
much. And your questions were amazing. And I appreciate getting a chance to sort of dive deep on some of my thoughts.
With pleasure.
All right, Eric.
So, to all the listeners who have, just listen to this podcast on any podcast platform, please leave a review. And also, if you haven't seen our videos on YouTube, you can watch them. The viewers on YouTube, you can like it if you like this video. Subscribe if you haven't yet, and of course, leave a comment. Bart, would you like to add anything?
We will see each other at the next episode of the Gold Republic Podcast.